In 1694, Britain was drowning in debt. Wars with France had drained the treasury. Gold was gone, trust was thin, and credit, the invisible backbone of empire, was collapsing. Then, something unprecedented happened. A group of private financiers offered the crown a deal that would change the course of history. They would lend the government money, real money, gold and silver, in exchange for a privilege no one had ever possessed before: the right to create money from debt. That bargain created the Bank of England. It looked like a solution. In fact, it was a silent revolution. From that moment, money was no longer wealth. It was a promise backed not by gold, but by the credibility of the state. And that credibility, in turn, rested on power, on colonies, ships, and the guns that secured them. The British Empire, we are told, was built by trade, by industry, by innovation. That's the visible story. But beneath the surface ran another current, quiet, technical, almost invisible. A financial system designed to turn war into profit and debt into expansion. Every conquest was also a loan, every victory an investment. Some historians believe this was Britain's true invention, the monetization of empire. The idea that a nation could fund its ambitions not with treasure, but with confidence, and then make the world pay interest on that confidence. And it worked. The East India Company conquered continents using borrowed money. The Royal Navy ruled the seas financed by bonds. London became not just a capital, but a clearinghouse of global debt. The empire wasn't merely a map, it was a balance sheet. But the real secret was subtler. This system didn't need constant war to grow. It only needed trust and the fear of losing it. Credit, after all, is a shadow that disappears when you turn on the light. By the time the world noticed, Britain had created something entirely new, an empire powered not by gold, but by belief. And that belief, carefully managed, traded, and enforced, became the most valuable export of all. The end of the 17th century was an age of uncertainty. England had just emerged from civil war, financial panic, and dynastic upheaval. The crown was weak, Parliament stronger, and the merchants of London richer than ever. Europe was a chessboard of debt and ambition. Wars were fought as much in the counting houses as on the battlefield. Britain's problem was simple. Wars were expensive, but taxes were slow. The state could no longer finance empire through plunder or bullion alone. The old model, spend gold, win colonies, bring gold back, had reached its limit. Gold was finite. Ambition was not. Something had to change. In 1694, the new mechanism appeared, the Bank of England. Officially, it was founded to stabilize public finance. In practice, it transformed the meaning of wealth. Investors subscribed £1.2 million in capital, lending it to the government at 8% interest. In return, they received a royal charter to issue notes, paper promises, against that same loan. The money that financed the state now circulated through the public as currency. Debt became liquidity. The invisible became real. The effect was immediate. London's merchants began to treat paper as gold. Bills of exchange multiplied. A new class of instruments, bonds, annuities, shares, began to replace coin. The city became the empire's nervous system, pulsing with promises. Yet this revolution was not democratic. The bank was private. Its shareholders were few, its influence immense. It served the state, but only because the state served it in return. The crown gained credit, the financiers gained control. It was a mutual dependence, and a silent one. Over the next century, that partnership deepened. The national debt, once a temporary measure, became permanent. An inheritance passed from one war to the next. By 1750, Britain owed more than £70 million, an enormous sum for its time. But that debt was not weakness. It was power, because it bound investors, merchants, and politicians into one system. Every bond sold was a vote of confidence in empire. Every pound borrowed was a promise to expand, protect, and collect. The colonies supplied raw materials, the Navy ensured trade, and the bank provided the oxygen, credit. Debt was no longer a burden, it was a business. And yet, there was a paradox. The very strength of this system rested on fragility, on belief that the paper was sound, the empire stable, the government solvent. When that belief trembled, panic followed. The South Sea bubble of 1720 showed how quickly speculation could turn into collapse. Fortunes evaporated overnight. But the mechanism survived, because the logic was too profitable to abandon. By the dawn of the 19th century, Britain had turned this fragile equilibrium into a machine. The bank financed wars against Napoleon, the Navy secured trade routes, and the colonies provided the resources that fed the loop. The empire was now self-funding, a perpetual motion device powered by debt. And what began as a national experiment quietly became global policy, because if credit could build an empire once, why not again? If this gave you a clearer view of how power learned to live on debt, tell me where you're watching from. By the early 1800s, Britain's financial engine was running at full speed and overheating. The wars with Napoleon had consumed unimaginable sums. Between 1793 and 1815, Britain borrowed more than 800 million pounds, an astronomical figure for the era. Gold reserves dwindled, paper notes multiplied, and trust, that invisible currency, began to stretch thin. In 1797, the inevitable happened. The Bank of England could no longer redeem its notes in gold. The government suspended convertibility, a polite phrase for admitting that paper had outgrown metal. For the first time, money existed by decree, not by weight. The British public was told this was temporary. It lasted 24 years. During that time, Britain fought and won its greatest wars, built the world's largest navy, and transformed its financial markets, all on money that no longer had a tangible base. Gold was locked away. Confidence became currency. The mechanism was brilliant, but dangerous. Every note issued was a small act of faith. Every act of faith demanded proof, and proof required victory. The empire's military and financial fronts became inseparable. Battles were fought to sustain credit, and credit sustained the battles. Then came the reckoning. When the war ended in 1815, Britain faced its own paradox. The empire had expanded, but the economy was exhausted. Prices soared, wages collapsed, and the gold that once backed every promise was nowhere near enough to support the ocean of paper now circulating. The government faced a choice: accept inflation and continue the illusion, or restore the old standard and risk collapse. It chose orthodoxy. In 1821, gold convertibility was restored. The return to the real standard was celebrated as moral victory, but economically it was a straitjacket. The sudden contraction in credit strangled trade and industry. The empire's invisible fuel, liquidity, evaporated overnight. Factories closed, unemployment soared. Britain's first industrial depression began not because of war, but because the financial system demanded purity. The irony was clear. The empire that had learned to live on paper now punished itself for doing so. The very tool that had made expansion possible, elastic credit, was condemned as deceit. Yet without it, the empire's rhythm faltered. This tension between the visible gold and the invisible promise became Britain's defining dilemma for the next century. Every boom, every crisis, every imperial venture was haunted by that duality. Too much faith, and trust collapses. Too much restraint, and growth suffocates. It was not a story of greed or corruption. It was the mathematics of empire, a system that could not exist without expansion and could not expand without illusion. The rest of the world saw British power as physical: ships, colonies, flags, but its true foundation was psychological. The empire worked only as long as everyone believed it would. And belief, unlike gold, cannot be stored in vaults. To understand how the empire survived its own contradictions, we must look not at its armies or colonies, but at its accounting. Britain turned debt into an ecosystem. Every coin, every note, every bond was a thread in one vast web of promises. The structure was fragile, but it was built to endure through motion. Here's how it worked. The Bank of England issued notes, paper backed by government debt. The government, in turn, borrowed from investors, pledging future taxes as collateral. Those taxes came largely from trade, and trade came from the colonies. The colonies were financed by merchants who borrowed from London banks using those same notes. The money left London, circled the globe, and returned multiplied, as interest, as imports, as taxes again. It was a loop, self-reinforcing, elegant, and largely invisible. The more debt the empire created, the more currency it produced. The more currency circulated, the more trade expanded. And the more trade expanded, the more revenue justified new debt. This was not a vicious cycle, it was a profitable one. Britain had invented a machine for compounding confidence. But no machine runs forever without lubrication. That lubricant was information. The City of London became a nervous system of prices, shipping reports, and credit ratings. Its traders knew, often before ministers did, where the next crisis or opportunity would arise. In that sense, the empire was an early data economy, built not only on goods, but on intelligence. By the mid-19th century, this system had reached maturity. The gold standard acted as its moral code. Every pound could, in theory, be converted into gold. In practice, few ever asked. The promise was enough. The illusion of stability created real stability, until it didn't. When gold flowed out, as during wars or trade imbalances, the bank tightened credit. Interest rates rose, colonies felt the squeeze, merchants went bankrupt. But the discipline of the gold standard made London the world's banker. Others trusted its rigidity more than their own flexibility. And so, foreign governments began to store reserves in London. Latin American republics, Indian princes, even rival European powers deposited gold in British vaults. In exchange, they received paper, sterling bills, which functioned globally like a second currency. The empire was no longer just British territory, it was a financial space, stretching from Bombay to Buenos Aires. Every pound circulating abroad extended Britain's reach without firing a shot. The Bank of England quietly became the world's central bank before the term existed. When a foreign state faced a crisis, London stabilized it, lending, restructuring, advising. Each intervention deepened dependence. That was not punishment, it was discipline. And that is how invisible power operates, not by conquering, but by denominating. Britain had built a system where the flow of money mattered more than the flow of armies. Trade routes became pipelines for capital. Colonies became collateral. It was a quiet genius and a quiet trap. For the empire itself could never step outside its own design. The moment Britain stopped expanding credit, its dominance would begin to contract. The engine that built the empire was now the chain that bound it. By the dawn of the 20th century, Britain's invisible machine had reached its limit. What began as innovation had hardened into dependence. The empire was now held together by contracts, interest payments, and a fragile faith in the pound's supremacy. And like all systems built on trust, it began to crack where belief thinned first, on the edges. The colonies no longer saw debt as partnership. They saw it as control. Railways, ports, and telegraph lines built with British loans tied them economically to London, not to themselves. Every mile of track carried invisible interest back to the city. Each customs office doubled as a repayment mechanism. The empire looked vast, but its core was narrow, a single financial center balancing the world's books. Then came 1914. The Great War exploded the illusion of permanence. In 4 years, Britain spent more than it had in the previous century. Gold fled, loans ballooned, and the United States, once the debtor, became the creditor. By 1918, London was no longer the world's bank. It was its largest borrower. The invisible engine reversed direction. The government tried to restore the pre-war order. In 1925, under Churchill, Britain returned to the gold standard at the old parity, ignoring the new reality. The result was economic suffocation. Exports collapsed, wages fell, strikes paralyzed the country. The pound was strong on paper but hollow in substance. In 1931, the illusion ended again. Convertibility was suspended. The same ritual repeated from 1797, only now the stage was global. The empire survived, but its logic began to rot. The colonies no longer needed British credit to grow. They needed freedom to trade on their own terms. Yet every demand for independence threatened the financial spine of London. To lose colonies was to lose collateral, and without collateral, the pound's prestige would unravel. World War II delivered the final blow. Britain financed its survival through massive borrowing, this time from America. By 1945, victory had a price, near insolvency. The empire's wealth was now booked in Washington's ledgers. The pound gave way to the dollar, London to New York. But the mechanism did not disappear, it migrated. Sterling, once global money, became regional. The colonies became Commonwealth. The same flows continued under new names: aid, investment, development loans. The structure endured because its logic was too convenient to abandon. Debt had become the most reliable form of influence, and Britain, the teacher of that craft, now lived by its own lessons. The cost of empire was not just material decline, it was dependency inverted. The system that once drew wealth inward now pulled it outward, through interest payments, through dollar settlements, through invisible commitments signed generations earlier. The British Empire did not collapse in fire, it dissolved in balance sheets. And in that quiet disillusion lay the true price of invisible power, that sooner or later it owns even its creator. Today the empire is gone, but its logic remains. The names have changed, the mechanics have not. What was once called imperial credit is now called global finance. The City of London still moves trillions each day, though the ships that once carried silver and spice have long vanished. The new vessels are digital: wires, screens, algorithms. But the current flows the same way: outward in search of yield, and back in search of security. The gold standard became the dollar standard. The colonies became markets. The old imperial charter was rewritten in the language of international law. Yet the same pattern repeats. Power expressed not through possession, but through debt. Then it was a governor's signature, now it's a bond rating. Then it was the East India Company, now it's the offshore fund. The geography changed, but the hierarchy remained. Those who issue credit command those who depend on it. Look at the map of tax havens. Nearly all trace back to the British system. The Cayman Islands, Bermuda, Jersey, Gibraltar, Hong Kong, Singapore. Fragments of empire turned into financial shelters. Legal remnants became global leverage points. London is still the hub. The spokes now form an invisible archipelago of secrecy. Money no longer sails, it teleports. And what about the currency itself? The pound lost its crown, but the city found a new role: the broker of global liquidity. When nations borrow in dollars, the deals often clear through London. When corporations hide profits offshore, the papers still lead back to British law firms, British banks, British trusts. The empire was territorial, the system that replaced it is jurisdictional. It rules by rule book, not by flag. This continuity is not coincidence, it's design. After the Second World War, as decolonization unfolded, British policymakers quietly prepared for financial recolonization. The sterling area turned into the eurodollar market, a network where US dollars, held outside US control, could circulate freely. The first major center? London, 1957. It was a perfect irony. The empire that lost its colonies became the custodian of other nations' capital. Britain learned that to govern without ruling, you only need to control the plumbing of money. And so the pattern persisted. Instead of armies, there were regulations. Instead of treaties, there were contracts. Instead of tribute, there were interest payments. Today, the Global South still exports raw materials and imports finance. The balance looks familiar. A century ago, British bankers dictated loan terms in Calcutta. Today, global institutions do it in Nairobi or Buenos Aires. The face has changed, the accents softened, but the logic is the same. Credit as power, debt as discipline. Some economists call this market efficiency. Others see it as history repeating under a new logo. The coincidence is too precise to be accidental. And now imagine, what if the British Empire never truly ended? What if it simply changed its form? Trading territory for transactions, gunboats for balance sheets. The invisible money that once built the empire may not be a relic. It may be the prototype of our entire world economy. Because the secret of empire was never gold or land, it was belief, the quiet, measurable faith that someone, somewhere, will pay tomorrow. 3 centuries ago, a handful of men in London discovered a truth that still shapes the world. Control the flow of credit, and you control the future. Empires rise and fall, but the architecture of belief endures. The British learned to build power not on conquest, but on confidence, a system so refined that it could outlive its own empire. The Bank of England became a blueprint for every central bank that followed. The colonial model became globalization's financial map. The techniques change names, but not purpose. We still live inside that design. The numbers on our screens are heirs to the same promises written on parchment in 1694. Every bond, every loan, every digital transaction carries a trace of that first bargain. The idea that value can be created from obligation, and obligation can be turned into rule. History didn't vanish, it became infrastructure. And so, when we speak of the global economy, we're not describing a new phenomenon. We're describing the afterlife of an empire that learned how to live forever in balance sheets. Its borders are invisible. Its flag is trust. Its capital is everywhere money moves faster than memory. Perhaps that is the real secret. Empires don't die. They compound.